Now we're going to look at a merchandise sales example. So as you can see here, we have an invoice that's from Break a Leg Clothing Company, and Break a Leg is going to be the seller this time. On the merchandise purchases video, Break a Leg is the buyer. So Break a Leg's contact information is right below its name, right here. Then we have the transaction date, which is November 1st. Let me zoom in so you can see it. Then we have the invoice number of 1,000. That is the transaction number. Okay, don't worry about this 4 here and it 100. So right below Break a Leg's information, we have the customer information. So where it's being billed to, this invoice. So we have the customer as the buyer and their contact information right below its name. And this is what the customer bought. They bought in total of 40 t-shirts, blue, green, and black t-shirts. You have the unit price per t-shirt. You have the amounts, the total amounts as well. So the total amount came out to be $2,000. And I'm going to put on here credit terms 210 net 30, which means that if the cash payment is received by the buyer within the 10 days from the transaction date or by the 10th day from the transaction date, 2% discount will be applied on that cash payment that's received from the customer. Otherwise, there's not going to be a discount applied if payment is made after the discount period, but the payment needs to be received by the 30th day from the transaction date. Okay. So when it comes to the seller side of things, the seller is going to use their perpetual inventory system. When it comes to recording the revenue and also recording the expense. So under this system, yes, once the sale is made, the revenue is going to be reported along with the expense as well, because the expense is going to be reported along with the revenue that's generated in real time. So if the sale is made on November 1st, the revenue is going to be recognized on that date, and the expense is going to be recognized on that date as well, because you're recording or recognizing revenue and expense in real time. That's what perpetual means. So let's set up the general journal for Break a Leg, because it's going to be Break a Leg's books. So we're going to put on here transaction number, date, general journal, debit and credit. Okay, so transaction number here, 1,000. The date, November 1st. So since this is an invoice, and at the very bottom here, I put on here the credit terms. This lets us know that cash was not exchanged yet. So because of this, or because of that, accounts receivable is going to be debited. Specifically, Jackie, the customer's name, Jackie Retail Store. It's going to be debited for $2,000. So accounts receivable is an asset because this is going to be an IOU from Jackie Retail Store, because a sale was made, but it was made on credit, even though cash has not been received yet. The other account that's going to be affected is going to be sales revenue. It's going to be credited for $2,000. And this is to recognize revenue. On that same date, since we're using the perpetual inventory system, 11-1, don't worry about the transaction number. We're going to also have to report or recognize the expense that went along with generating this $2,000 of revenue. Okay, so when it comes to recognizing the expense, we see that we have a total of 40 t-shirts. I already did the calculation as far as with how much it costs break a leg, those 40 t-shirts. So I did the math already, and it came out to be $345. So to recognize the expense, we have to first take out the cost from the inventory balance. In order for us to do that, we're going to have to credit merchandise inventory. And we're crediting that account by $345. So that's going to reduce the balance in that account. And merchandise inventory, yes, it is an asset. So we're going to move this $345. This is what's happening here. We're moving this $345 in an expense account called cost of goods sold. We're going to debit this account by $345. All right. So this is us recognizing the expense on the same date as when the revenue was recognized. And that's what perpetual inventory system means. So perpetual inventory system, going back up here, it's similar to the gross method for the buyer, because this initial sale here that is recognized, you notice that discount is not applied, allowance is not applied, returns are not applied. It's just the initial sale that happened. You're recording what happened on that date. Since it's perpetual, you're reporting the revenue and the expense on the same date in real time. Now, let's say that the cash payment was made after the discount period, and we're going to use November 15th because that's the date that's after the discount period. So if the cash payment was received, not made, if the cash payment was received by Break a Leg after the discount period, they're going to first reduce this accounts receivable account by $2,000 by crediting that account. Okay, it's going to be Jackie Retail Store. You're crediting that account by $2,000. Why? Because Jackie made the cash payment. So since the cash payment was received, cash is going to be debited for that same amount. So you're just eliminating this balance here in the receivable that was recorded on November 1st. Now we're going to say that the cash payment was received within a discount period. What does that look like in Break a Leg's books? So the date that I'm going to use is going to be November 8th. So we're saying that the cash was received on November 8th. This means that it was within the discount period because we had until 10 days to make the cash, or 10 days from when for the cash to be received in order for the discount to be applied. The initial transaction date was November 1st. So 10 days from November 1st is November 11th. So we see here that November 8th, that's when the cash was received. Discount is applied. It will be honored. So a couple of things we need to do is we need to first figure out first thing we need to do is eliminate the accounts receivable balance. That's the first thing we're going to do. Now, we're going to start with the November 1st transaction that you see here on the screen. This is what we're basing our discount from. Oh, I thought I erased everything. I guess I didn't. There we go. So as you can see here on November 1st, accounts receivable was debited for $2,000. Sales revenue was debited for $2,000. So we're only focused on the receivable side of things because the cash payment was received within the discount period. So this receivable balance of $2,000 is going to be eliminated. And to eliminate it, we need to credit this account. So I'm going to credit accounts receivable dash Jackie Retail Store by $2,000. Okay, that's going to eliminate that balance. That's the first thing you need to do. Second thing you need to do is figure out what the discount is going to be. That's going to be applied to the cash that was received. So the discount is going to be calculated from this 2,000 here. So we're going to take 2,000. You can either multiply it by 98% to get 1960, or take 2,000, multiply it by 2% to get $40. Take 2,000, multiply it. Sorry, nope, not multiplying it. Subtracting 40 from it, and that's going to give you your 1960. Either way, as long as you get to this 1960, no matter which way you get to it, it's fine. That's the correct amount. So this amount here is going to be the cash received amount. That's the cash amount that's going to be debited. All right. So that amount, 1960, is going to be debited to cash for 1960. So yes, there is a difference. We got 1960 on the debit side, 2,000 on the credit side, which means that this $40 difference here is going to be debited to an account called sales discounts. Okay, what type of account is sales discounts? It is a contra revenue account. What does that mean? This contra revenue account, because I know there's questions out there about this. Contra revenue account, it's an account that reduces the balance from a main account. In other words, for this one, sales discount is a contra revenue account, so it's going to reduce the balance in this sales revenue account here. So when a discount is applied, whatever the cash amount that's received, the revenue that was recorded initially should also match that cash amount that was received. So we see here cash of, let's see, 1960. That's recorded on 11/8. Revenue needs to match that as well. So when it comes to revenue, we're going to take the sales revenue amount that was initially recorded on November 1st of $2,000. I'm going to put that here, $2,000. And this is our sales revenue. And we're going to subtract out our sales discounts of $40. And that's our sales discounts. That's going to give us 1960, which matches the cash received. Cash is everything. Cash is very important. So the inflows and outflows of cash, that's what really matters. So whatever's recorded in revenue, it needs to match up with cash. Okay. We're not done yet on this video. We got some more things that we need to do. All right, so that was an example of when the cash payment was received within the discount period. Now, what does it look like when returns occurs, like sales returns and allowances? What does it look like then? So when it comes to sales returns and allowances, it's going to look a little different than if you were the buyer. So I'm going to actually put here a scenario. So I'm going to put on here on November A, Jackie retail store paid $19.60 within the discount period. Got a doctor's handwriting. Okay. First thing we got to do is record the sale that was made on credit on November 1st. And the second thing to do is to record the payment received within the discount period, which we already just did up here. Okay, but I'm going to clean it up and do it again. So let's first start off with this portion of it before we get into how to record the returns that occurred. So setting up the general journal here, I'm not going to worry about the transaction number, date, general journal, and debit and credit. All right, so the initial sale that occurred was on November 1st, so we're going to just record this initial sale using the perpetual inventory system. So the initial sale that was made on credit, we're going to debit accounts receivable dash Jackie retail store for $2,000. And we're going to credit sales revenue for that same amount. And this is to recognize the revenue. Since the perpetual inventory system is used, we're going to also recognize the expense by debiting cost of goods sold for $345, because I've already did the calculation of how much it costs Break a Leg to acquire those t-shirts. And we're going to credit merchandise inventory, reducing the inventory balance by that same amount because that was what was sold and it needs to now be removed from the inventory account. So November 8th is when the cash payment was made or received. So November 8th, we have a receivable balance of that $2,000 here that needs to be eliminated because the cash payment was received by Jackie Retail Store. So to eliminate that balance, we're going to credit accounts receivable dash Jackie Retail Store. And it's going to be for $2,000. Discount was applied of 2% since the payment was received within the discount period. And it gives us the amount of $1,960. That's the cash payment that was received. So cash is going to be debited for $1,960. So the difference of $40 is going to be credited to sales discounts. Okay, now there's the contra revenue account that's directly connected to the main revenue account. So that's going to bring the balance down from the revenue account. So no different than what was shown previously. Now we're going to have an example of returns. How do we apply the returns? So we're going to say on November 15th, Jackie Retail Store returned items that were sold for $50. The cost of those items that were returned was $15. So what we got to do is record the returned items that occurred on November 15th. Right? So reading this again, The items that were returned was sold for $50. Those items that were returned cost $15. Now here where it says cost $15, this cost break a leg $15. So I just want to throw that out there. So what break a leg needs to do, they need to make two adjustments. They need to make an adjustment to their revenue account, and also they need to make an adjustment to their expense accounts. So they got to recognize this, since they're using a perpetual inventory system, and a sale was, when a sale is made, they are recognizing the revenue, and they also are recognizing the expense that went along with generating that revenue in real time. So whenever return happens, they're going to also have to make an adjustment to the revenue that was recognized, and also make an adjustment to the expense that was recognized as well in real time. So setting the general journal up, we're going to put on here date, general journal, debit, and credit. Okay. So first thing we need to do is, put in the date, 11/15, and we need to go ahead and make the adjustment to the revenue account. So by doing that, we know here that the cash payment was received on November 8th. So we don't need to adjust the accounts receivable account accounts receivable balance, because there isn't any balance in that account, because the customer already made the cash payment of $19.60, which is reflected in the cash account as an increase. So the return happened after the cash payment was received, which means that the cash account now is going to be credited to reflect the return of $50. Now, let's say if the cash payment wasn't received yet, and the return actually happened prior to the cash payment being received. In this case, the accounts receivable account will be credited, not cash. But since cash has already been received and then the return occurred afterwards, then that's when the cash account will be credited for $50. So this will reflect a refund. So $50 of cash is going to go back to the customer. So the account that's going to be debited is going to be an account called, pretty similar to sales discount. Instead, this is going to be sales returns and allowances. That's going to be debited for $50. And the reason why I say it's similar to sales discounts is because this is also a contra revenue account that's directly connected to the main revenue account of sales revenue. So you got two contra revenue accounts here. Sales discounts, which is right here, and then sales returns and allowances. So this is to adjust the revenue account. So after this, you got to adjust the expense account. So on 11/15, to adjust the expense account, I'm going to go back up here. There we go. And all we're going to do is, you see these names here, cost of goods sold and merchandise inventory. We're just going to reverse them because we have to reverse the expense that was recognized. So since the cost, so since these items that were returned cost $15 to break a leg, we're going to then now debit merchandise inventory. Oops, there we go. Inventory for $15. We're going to credit cost of goods sold for that same amount. So this here, we're just reversing the expense that was reported initially. So this is to adjust the expense account.